In the early 1980s, a legendary trader named Richard Dennis made a bold bet. He believed trading success wasn't about talent or instincts. It was about following a system. To prove it, he recruited a group of ordinary people: an accountant, a security guard, even a young kid fresh out of school. And in just a few years, they made over $100 million. They became known as the turtle traders. But here's the real question. Can ordinary people like you and me still use this same strategy today to beat Wall Street and thrive in modern markets? In this video, I'm going to break down the exact rules the turtles followed, the psychology that made them unstoppable, and how you can apply this system in 2025. Whether you trade stocks, crypto, or Forex, let's get started. The origin story. To really understand the turtle trading strategy, we need to go back to Chicago in the early 1980s. At the center of the story were two men: Richard Dennis and his longtime friend and partner, William Eckhart. Both were traders, but they had very different beliefs about what made someone successful in the markets. Richard Dennis, known as the Prince of the Pit, had turned a small $400 loan into over $200 million in trading profits before he was even 40 years old. He was a legend in the futures markets, trading commodities like corn, soybeans, and oil. Dennis believed that trading wasn't about natural talent, luck, or even years of experience. Instead, he was convinced that trading success could be reduced to a set of simple, teachable rules, a mechanical system that anyone could follow. William Eckhart, however, strongly disagreed. He believed that successful traders were born, not made. In his view, trading required special intuition, mental toughness, and the kind of instincts that couldn't simply be taught from a book. To him, the ability to handle risk and read the markets was more like an art than a science. The two debated endlessly about this, and finally, one day, they decided to settle it with an experiment. Dennis declared that he could take a group of complete beginners, people with no prior experience in trading, and train them to become successful traders. To prove it, he announced that he would teach them his exact rules, give them real money to trade, and then see if they could succeed. It was a bold wager, what would later be remembered as the famous $400 bet. Not because he was risking only $400, but because that was the amount he himself had started with before building his fortune. It symbolized his belief that trading success didn't depend on starting capital or talent, but on discipline and following a system. The recruitment of the turtles. So, how do you test an idea like this? Dennis decided to run what was essentially a social and financial experiment. In 1983, he placed ads in newspapers like the Wall Street Journal, inviting ordinary people to apply for a chance to become traders under his guidance. The applicants came from all walks of life. There was an accountant, a security guard, a professional, gambler, a sound engineer, even a 19-year-old kid who had barely any life experience at all. None of them were Wall Street professionals. None had fancy degrees in finance. They were just regular people with curiosity and ambition. Dennis called this group his turtles, inspired by a trip he had taken to Singapore. While visiting a turtle farm there, he saw how turtles were bred and raised in large numbers with consistent methods. He thought, if traders can be bred the same way, raised with consistent training and discipline, then maybe success could be replicated, just like farming turtles. Hence, the name stuck. The Turtle Traders. Training the turtles. The training was shockingly short. Over just 2 weeks, Dennis taught his recruits a very strict set of rules. These rules covered everything from when to enter a trade, when to exit, how much to risk, and how to manage losing streaks. There was no guesswork, no gut feeling. No secret insider knowledge. The core of the strategy was trend following. If a market broke out to new highs, the turtles would buy. If it ain't year or broke down to new lows, they would sell. They were taught to let profits run, cut losses quickly, and most importantly, manage position sizes carefully so that no single trade could destroy their account. Imagine the simplicity. Buy when the market is going up, sell when it's going down. But do it with strict rules that remove emotion from the process. That was the turtle system in a nutshell. It wasn't glamorous. It wasn't about predicting the future. It was about reacting to what the market was already doing and having the discipline to stick with the rules no matter what. The results. Now here's where the story gets incredible. After just a few weeks of training, Dennis handed these complete beginners real trading accounts with his own money, sometimes hundreds of thousands of dollars, and set them loose in the markets. The results shocked everyone. Collectively, the turtle traders went on to make over $100 million in just 4 years. Some individuals made millions for themselves and went on to have long, successful trading careers. What's more, their success proved Dennis's point. Ordinary people, when given the right system and the discipline to follow it, could compete with and even outperform seasoned Wall Street professionals. The experiment settled the debate. Trading, Dennis proved, was not an innate gift. It was a skill, a process that could be taught, learned, and applied with discipline. The turtle traders became living proof of this idea. Why the name matters. But let's pause here and reflect on why. The name turtle strategy is so important. Richard Dennis chose it deliberately after seeing turtles being raised in farms. His vision was simple. Just as turtles could be raised in large numbers with consistent methods, so too could traders be raised using a systematic process. In other words, trading success wasn't a mystery. It wasn't reserved for the lucky few. It could be replicated, scaled, and taught. That was the groundbreaking insight. The turtle strategy wasn't just about making money. It was about democratizing, trading knowledge. It showed that a rules-based system could level the playing field between Wall Street elites and everyday people. The legacy of the bet. Today, decades later, the turtle experiment is still one of the most famous stories in trading history. It's been written about in books, studied in finance courses, and even adapted into modern algorithms. And while the exact rules they used have been modified over time, the core lessons remain timeless. Follow the trend. Don't fight it. Stick to your rules. No matter what, risk management is everything. And most importantly, discipline beats talent. The $400 bet between Richard Dennis and William Eckhart may have started as a friendly argument, but it ended up proving something revolutionary. That with the right system, ordinary people can achieve extraordinary results. Now that you know the story of how the turtle traders began, the $400 bet, the training, and the results, the natural question is, how exactly did the rules work? What made this system so powerful, and why did it succeed when so many other strategies fail? Let's break down the core principles of the turtle strategy in the next section. Core principles of turtle trading. Now that you understand the story of how the turtle traders were born, let's dive into the heart of the strategy itself. What exactly were these rules that turned complete beginners into million-dollar traders? At its core, the turtle strategy is about something very simple: following trends. This is called trend following, and it's one of the oldest and most proven approaches in trading. Let me explain it in plain English. Trend following. Explained. Imagine you're at the beach and you notice a strong wave coming in. If you catch the wave early and ride it, you'll go far. But if you try to fight against it, you'll get crushed. That's exactly what trend following is about in the markets. Instead of trying to predict where prices will go next, trend followers simply look for strong moves, whether up or down, and then ride them for as long as they last. The idea is simple. Markets often move in sustained trends. Oil prices may rise for months. Gold may fall for weeks. Tech stocks may soar for an entire year. These moves can be massive, and catching even a portion of them can lead to huge profits. The turtle traders didn't care about predicting the top or the bottom. They only cared about catching the middle part of the move, the safest part of the trend. This is the first principle of the turtle strategy. Trade with the trend, not against it. Buy markets that are going up and sell markets that are going down. Forget trying to call reversals. Forget trying to outsmart the market. Just follow the flow. Entry rules, breakouts. So how did the turtles know when to get in? They used a very mechanical system based on breakouts. Here's how it worked. They watched for when a market made a new high or a new low compared to recent history. For example, if a market broke above the highest price of the past 20 days, that was a signal to buy. If it broke below the lowest price of the past 20 days, that was a signal to sell. Why does this work? Because breakouts are signs that a new trend may be starting. If prices push above their recent ceiling, it means buyers are strong. If prices fall below their recent floor, it means sellers are in control. Either way, the market is showing momentum, and the turtles wanted to ride it. They also used different breakout lengths to filter signals. A short-term breakout might catch a fast-moving trend, while a longer breakout would catch bigger, more sustained moves. For example, they sometimes looked at 20-day breakouts for entries, but confirmed them with 55-day breakouts for longer trends. The beauty of this system is its simplicity. There's no guessing, no analyzing company balance sheets, no worrying about economic forecasts. Just pure price action. When the market makes a new high, buy. When it makes a new low, sell. Exit rules, stop losses and trailing stops. But getting into a trade is only half the battle. The real challenge is knowing when to get out. And this is where most traders fail. They either hold on to losers too long, or they take profits too quickly. The turtles solve this with two powerful tools: stop losses and trailing stops. Stop losses were non-negotiable. The rule was simple. If the market moved against them by a certain amount, they exited immediately. No second guessing, no waiting to see if the market would turn around. Losses were cut quickly and mechanically. This protected them from catastrophic drawdowns. But what about winners? That's where trailing stops came in. Instead of taking profits after a small move, the turtles let their winners run. They used moving averages of volatility to set exit points. If the market reversed enough to hit their trailing stop, they would exit and lock in profits. This is critical. The turtles didn't try to predict when a trend would end. They stayed in until the market itself forced them out. This is why trend following works. A few huge winners often make up for dozens of small losses. In fact, the turtles expected to lose on the majority of their trades, but the winners were so big they more than paid for the losses. This brings us to the second principle. Cut your losses quickly, but let your winners run. Most traders do the opposite. They take small profits, but hold on to losers. The turtles flipped that upside down, and it's one of the main reasons they succeeded. Position sizing, risk per trade. Now, here's the part most beginner traders ignore. But it was the backbone of the turtle strategy, position sizing. Richard Dennis knew that even with a good system, traders could blow up if they risked too much on a single trade. So he taught his students to calculate their position size based on volatility. In simple terms, this meant that the turtles didn't just buy or sell a random number of contracts. Instead, they measured how much the market typically moved in a day, and then adjusted their trade size so that if the market went against them, they would only lose a small fixed percentage of their account. Usually, they risked about 1 to 2% of their capital per trade. This might sound small, but it was key to surviving losing streaks. Imagine risking 10% per trade. Just 5 losses in a row could wipe you out. But if you only risk 1%, you can survive dozens of losses and still have money left to catch the ears. Next big trend. This principle is vital. Many traders focus only on entries and exits, but the turtles proved that how much you risk matters more than when you enter. Even an average strategy can work if you manage risk properly. Position sizing also allowed them to diversify across multiple markets, currencies, commodities, bonds, and stocks, without ever being overexposed in one place. This diversification smoothed out their equity curve and reduced the emotional strain of trading. Putting it all together, let's recap the system in simple steps. Look for a breakout. When a market makes a new high or low compared to the last 20 or 55 days, that's your entry signal. Take the trade. Buy on an upside breakout. Sell short on a downside breakout. Set a stop loss immediately. If the market moves against you by a predetermined amount, exit without hesitation. Let winners run with a trailing stop. Stay in the trade until the market reverses strongly enough to hit your trailing stop. Size your positions based on volatility. Risk only 1 to 2% of your capital on each trade. That's it. No complicated indicators, no insider information, no trying to outthink the market. Just rules, discipline, and patience. Why these principles still work? Now you might be wondering, this was the 1980s. Does the turtle strategy still work today? The answer is yes, but with adjustments. Markets are faster now, and technology has changed trading. But the principles remain timeless. Trends still exist in stocks, commodities, crypto, and Forex. Breakouts still work because human psychology hasn't changed. Risk management is universal. Without it, you won't survive. Discipline beats prediction every single time. Whether you're trading Bitcoin, Tesla, or crude oil, these same rules can guide you. The system forces you to trade with discipline instead of emotion. And that, more than anything, is what separates winners from losers in the market. So those are the core principles of turtle trading: trend following, breakout entries, disciplined exits, and strict risk management. In the next section, we'll look at the psychology behind the system, because knowing the rules is one thing, but having the mindset to follow them is an entirely different challenge. The psychology of turtle trading. We've covered the rules of the turtle strategy. Follow trends, use breakouts, cut losses, let winners run, and size positions carefully. But here's the truth. Knowing the rules is only half the battle. The real challenge, the part that separates those who make millions from those who lose everything, is psychology. Trading is not just numbers on a screen. It's an emotional game. Fear, greed, impatience, doubt. These emotions sabotage more traders than bad strategies ever will. Richard Dennis understood this, and that's why so much of the turtle experiment wasn't about the rules themselves, but about training the mindset to actually follow them. Losing streaks are normal. Let's start with one of the hardest psychological realities of trading. Losing streaks. Most people think professional traders win almost all the time. That's completely false, even with the legendary turtle. Rules. Most trades lost money. Think about that. The turtles were right less than 50% of the time. Sometimes only 30% of their trades were winners. Imagine placing 10 trades and 7 of them lose. For the average beginner, that's devastating. Most would give up after just a few losses. They'd start questioning the system, changing the how, rules, or abandoning trading altogether. But here's the key. The turtle strategy didn't need a high win rate, because when they lost, losses were small. And when they won, winners were massive, sometimes 10 times bigger than the average loss. That's the math of trend following. Lots of scratches and small cuts, but a few huge home runs. Psychologically, this is brutal. Losing trade after losing trade feels like failure. But the turtles were trained to expect it. They didn't see losing streaks as failure. They saw them as the cost of admission for the big winners that would come later. This is the first psychological lesson. Losing is normal. Success in trading doesn't mean winning all the time. It means managing losses until the big winners arrive. Handling risk and discipline. The second psychological pillar of turtle trading is risk management. Not just the math of it, but the emotional side. Here's the problem. Humans are terrible at handling risk. We hate losing money. Behavioral. Psychologists call this loss aversion. Studies show that losing $100 feels about twice as painful as winning $100 feels good. That means most traders will do irrational things just to avoid taking a loss. They'll hold on to losing trades, hoping they bounce back. They'll add more money to bad trades, trying to average down. They'll ignore their stop losses because they can't admit they were wrong. The turtles were trained to fight this instinct. Discipline meant never questioning the stop loss. If the market hit their exit level, they were out. No debate, no hesitation. They had to treat each trade as just one of many, not as a personal victory or defeat. Discipline also meant sticking to the rules, even when it felt wrong. Imagine this. You've just lost 5 trades in a row, all following the system. Now you see the next breakout signal. Your gut says, don't do it. The system isn't working. You're just going to lose again. But the rules say, take the trade. That one trade could be the monster trend you've been waiting for. If you skip it because of fear, you miss the winner that pays for all the losses. That's why the turtles had to override their emotions with discipline. This is the second psychological lesson. Discipline means trusting the system, even when every cell in your body wants to quit. Why most traders fail without mindset training. Now, let's talk about why most traders fail. Even when they have a good system, it comes down to mindset. Here's the harsh reality. The markets are designed to exploit human weakness. Prices rise just enough to make you greedy, then fall just enough to make you panic. The cycle repeats, shaking out anyone who can't stay disciplined. Most beginners enter trading thinking it's about finding the perfect strategy. They chase indicators, signals, gurus, or secret formulas. But even the best strategy in the world is worthless if you can't follow it consistently. And consistency is 100% psychological. Think about the turtle rules. They're public now. You can read books about them. You can download them online. Anyone can apply them. But here's the question. Why don't most people get rich with them today? Because most people can't handle the psychology. They abandon the system after a losing streak. They risk too much because they want quick profits. They break rules when they get emotional. They can't accept small, repeated losses while waiting for the big winner. In other words, the system doesn't fail. The trader's mindset does. This is why Richard Dennis chose ordinary people for his experiment. He wanted to prove that trading wasn't about intelligence, experience, or talent. It was about following rules with discipline. The hardest part wasn't learning the system. It was mastering your own emotions. The mental framework of the age, turtles. So how did the turtles succeed where most traders fail? They built a mental framework to deal with risk and uncertainty. Detached from outcomes, each trade was just one of many. They didn't celebrate wins or mourn losses. They treated trading like flipping a weighted coin, sometimes heads, sometimes tails, but profitable in the long run. Embrace uncertainty. They never pretended to know what the market would do. They accepted that the future was unknowable, and their job wasn't to predict. It was to react. Focus on process, not results. A winning trade taken by breaking the rules was still considered a failure. A losing trade taken by following the rules was considered a success. This flipped normal thinking upside down. Think in probabilities. Instead of thinking, this trade must win, they thought, over the next 100 trades, the math will work out. This long-term mindset helped them survive short-term pain, emotional neutrality. The turtles learned to view the market without bias, no hope, no fear, no attachment, just data, rules, and execution. Insight. Here's the ultimate truth about the psychology of turtle trading. The hardest battle isn't against the market, it's against yourself. The market will tempt you to break the rules. It will punish you for being impatient. It will play with your emotions until you second-guess everything. That's why the turtle strategy was so revolutionary. Not because of the breakout rules or the stop losses, but because it forced ordinary people to think and act with discipline. Richard Dennis didn't just create traders. He created mental warriors, people who could handle uncertainty, risk, and fear better than the average person. And that's why they succeeded. So remember this, the psychology of trading is not about eliminating emotions, it's about mastering them. Because at the end of the day, your greatest enemy in the markets isn't volatility, or Wall Street, or even bad luck. It's your own lack of discipline. Conquer that, and you've already won half the battle. Now that we've uncovered the psychological side of turtle trading, why losing streaks are normal, how discipline matters more than predictions, and why mindset training is everything, we're ready to test the strategy against history itself. In the next section, let's explore some of the most famous market events where the turtle principles were put to the ultimate test. Case studies and historical events. So far, we've explored the origins of the turtle traders, the rules they followed, and the psychology that made them strong. But nothing proves a strategy like real-world results. Let's step back into history and look at some of the most famous case studies, success stories from the original turtles, how they thrived during financial crises like Black Monday in 1987, and the timeless lessons that still apply to traders today, even in 2025. Success stories from the original turtles. When Richard Dennis launched his experiment in 1983, he didn't just produce average traders. He produced some of the most successful money managers of their generation. One of the most famous was Curtis Faith. He joined the program as just a 19-year-old kid, the youngest of all the recruits. Yet despite his age, he quickly proved to be one of the most disciplined and profitable turtles. Over the course of the program, Faith earned tens of millions of dollars trading Dennis's system. Years later, he wrote the book Way of the Turtle, where he shared his experience and revealed many of the original rules. Another standout was Jerry Parker. After the Turtle program ended, Parker went on to found Chesapeake Capital, a trading firm that managed billions of dollars. He became one of the best examples of how the Turtle principles could be turned into a long-term professional career. Even decades later, Parker still emphasizes trend following and discipline as the foundation of his approach. Then there was Paul Rabar, who eventually launched his own hedge fund, Rabar Market Research. He built on the Turtle principles and applied them to systematic global trading strategies, proving that the experiment wasn't just a one-time success, it could be scaled and institutionalized. Collectively, the group made over 100 million in profits in just a few years. Remember, these were complete beginners before the experiment. What set them apart wasn't talent or insider knowledge, it was their ability to follow the rules with unwavering discipline. Thriving during crises. Black Monday, 1987. Perhaps the greatest test of the turtle strategy came on October 19th, 1987, a day forever known as Black Monday. On that single day, global stock markets collapsed. The Dow Jones Industrial Average fell by over 22% in one session, the largest single-day percentage drop in history. For most traders and cat investors, it was a nightmare. Billions of dollars were wiped out in hours. Panic spread across Wall Street. Many funds and individuals were ruined. But for the turtles, it was an opportunity. Why? Because the system didn't care whether markets went up or down. It only cared about trends. And in October 1987, the trend was violently downward. The turtles had already been shorting markets as breakouts to the downside appeared weeks before the crash. When Black Monday hit, their positions exploded in profit. While most of Wall Street was drowning, the turtles were riding the wave. This is the beauty of trend following. It's direction agnostic. Traditional investors usually only make money when markets rise, but trend followers can profit in both bull and bear markets. The crash of 1987 was proof that systematic rules could protect traders from disaster and even turn crisis into opportunity. This event also highlighted another psychological advantage of the turtle strategy: emotional detachment. While others panicked, the turtles weren't making decisions in the heat of the moment. They were simply following preset rules. Their system had already placed them on the right side of the trend before the crash even happened. Other market examples. The turtles thrived in many environments beyond 1987. During the mid-1980s, currencies were highly volatile. The Japanese yen surged against the US dollar after the Plaza Accord in 1985, when governments intervened to weaken the dollar. This massive currency trend became a goldmine for the turtles, who rode the yen's strength for enormous gains. Commodities also provided rich opportunities. When crude oil prices trended strongly during geopolitical events in the Middle East, the turtles captured those moves. When interest rate futures spiked during changes in Federal Reserve policy, the system responded the same way. Simply follow the breakout, ride the trend, and manage the risk. These case studies show a critical truth. The turtle strategy wasn't tied to one asset or one decade. It worked across currencies, commodities, stocks, and bonds. It worked in bull markets and bear markets. Its power came from universal human behavior, fear and greed that drive trends in every market. Lessons that still apply in 2025. Now, let's connect these historical lessons to the world we live in today. Markets in 2025 look very different from the 1980s. We have high-frequency trading, algorithms, artificial intelligence, and global 24/7 markets like crypto. Does the turtle strategy still apply? The answer is yes, because while technology has changed, human behavior hasn't. Trends still exist. Fear and greed still create momentum, and discipline is still rare. Here are 3 timeless lessons we can carry forward. System beats emotion. Whether it's 1987 or 2025, emotions will always betray traders. A rules-based system provides stability when chaos strikes. Diversification protects you. The turtles traded across dozens of markets. In today's world, you can do the same. Stocks, ETFs, crypto, Forex, commodities. Spreading risk keeps you alive long enough to catch the big moves. Crises create opportunity. Black Monday proved that trend followers can thrive during panics. The same was true during the 2008 financial crisis, the 2020 COVID crash, and even recent volatility in cryptocurrencies. When others panic, systematic traders quietly profit. And maybe the most important lesson of all, discipline is timeless. Technology can evolve. Markets can get faster, but no algorithm can save a trader who doesn't stick to their plan. That turtle strategy's biggest gift isn't just a set of rules, it's the mindset to follow them. Looking back, the turtle traders weren't just lucky participants in a bold experiment. They were proof of concept that ordinary people, armed with discipline and rules, could outperform Wall Street professionals. Their success stories, their survival through Black Monday, and their ability to adapt across markets all point to the same conclusion. The principles of turtle trading are evergreen, and in a world as unpredictable as today's, those principles may be more valuable than ever. Because history will repeat itself. There will be more crashes, more bubbles, more manias and more panics. But just like in 1987, the traders who survive and even thrive will be those who have the discipline to follow rules instead of chasing emotions. Now that we've seen how the turtle traders applied their system during some of the most dramatic market events in history, let's shift to the present. How can we adapt the turtle principles to today's world of stocks, Forex, and even cryptocurrencies? Let's explore the modern applications of this timeless modern adaptations. We've seen how the turtle traders became legends in the 1980s, and how they thrived through some of the biggest market events in history. But that leaves us with a critical question. Does the turtle strategy still work? In today's markets, where stocks trade in microseconds, cryptocurrencies run 24/7, and algorithms dominate trading floors, the short answer is yes, but with adaptations. Let's explore how the turtle principles fit into modern markets, how we need to adjust risk management for today's volatility, and the tools traders now use to test and refine these timeless rules. Turtle rules in today's markets. First, let's look at the big three: stocks, crypto, and Forex. Stocks. In the 1980s, the turtles were focused heavily on futures markets. But the same breakout principles apply to stocks today. For example, when a stock breaks above its 20-day or 50-day high, it often signals strong momentum. Trend-following funds still use these breakout rules to capture moves in tech giants like Apple, Tesla, or Nvidia. ETFs also make it easier for retail traders to apply turtle-style diversification across sectors and indices. Cryptocurrencies are perhaps the purest form of modern trend following. Bitcoin, Ethereum, and altcoins can trend explosively, rising hundreds of percent in months or crashing just as quickly. The turtles' principles of strict stop losses and small position sizing are even more vital here. Many traders in crypto blow up accounts because they ignore volatility. Applying turtle rules brings structure to this chaotic market. Forex. The foreign exchange market is the largest in the world, and it trends beautifully when global economic conditions shift. Currencies often move in long, sustained directions when interest rate policies change, when governments intervene, or when global crises hit. Just like in the 1980s, a simple breakout strategy can still capture big moves in pairs like EUR, USD, USD, JPY, or GBP, USD, the takeaway. Turtle rules were never about a single market. They were about human behavior. And human behavior hasn't changed. Breakouts still happen, trends still run. Fear and greed still push prices too far. The principles remain as powerful in 2025 as they were in 1983. adjusting position sizing for modern volatility. Now, let's talk about one of the most important adaptations: position sizing in modern markets. The original turtles used a concept called the N-value, which measured volatility. They sized positions so that each trade risked about 1 to 2% of their total account, adjusted for how wild the market was. That was a brilliant idea in the 1980s, and it's even more critical today. Why? Because volatility has changed. Crypto markets can swing 10 to 20% in a single day. Stocks like Tesla or meme stocks like GameStop can double or collapse in weeks. Even Forex, which is usually more stable, can spike dramatically after central bank announcements. To adapt, modern traders use more dynamic position sizing. Instead of trading the same amount in every market, they scale their positions based on volatility metrics like ATR, average true range, measures how much an asset typically moves day to day. Standard deviation captures variability in returns. Volatility indexes, like VIX, helps gauge overall market fear. For example, if Bitcoin is swinging wildly, a turtle-style trader might only risk 0.5% per trade. But if a major stock index like the S&P 500 is moving steadily, they might risk 1 to 2%. The principle is the same as in the 1980s. Never risk too much on one trade. But the calculations now use modern tools to adjust for today's faster, more volatile markets. This brings us to a timeless truth. Risk management is the great equalizer. Whether you're trading corn futures in 1983 or Ethereum in 2025, survival depends on sizing your position so that losing streaks don't wipe you out. Tools and tech for modern turtle traders. Perhaps the biggest difference between the turtles of the past and traders today is technology. Richard Dennis trained his turtles with pen, paper, and chalkboards. They tracked prices manually. But in 2025, traders have access to an arsenal of powerful tools. Here are a few that bring the turtle system into the modern era. Backtesting software, platforms like TradingView, MetaTrader, or AmiBroker let traders test turtle rules against decades of historical data in minutes. This shows whether the system still works across different markets. Algorithmic trading. Many traders now code turtle rules into algorithms. This removes human emotion entirely. Computers follow the rules with perfect discipline, 24/7. This is especially useful in crypto and Forex, which never close. Risk management tools. Modern trading platforms allow automatic stop-loss placement, position sizing calculators, and even portfolio risk dashboards. The turtles had to calculate everything by hand. Today, software does the heavy lifting. Data. Analytics. With the access to global market data, traders can refine the original turtle rules. Some use machine learning to tweak breakout lengths, volatility filters, or portfolio diversification methods. But here's the key point. Even with all this technology, the heart of the system hasn't changed. The rules remain simple. The tools just make it easier to execute with consistency and discipline. Lessons for the modern trader. So what can we learn from these modern adaptations? First, simplicity still wins. The markets may be faster, but human psychology is the same. Simple breakout rules can still beat complex prediction systems. Second, risk management is even more important. Volatility is higher today, and markets move around the clock. Position sizing must adapt to survive. Third, use technology to your advantage. Backtesting, automation, and analytics make it easier to apply turtle rules without emotional interference. But perhaps the biggest lesson is this: don't abandon discipline just because markets look different. The turtles succeeded because they trusted their rules. Modern traders fail when they jump from system to system, chasing the next shiny indicator. Technology can help you, but it can't replace discipline. The turtle strategy was born in the 1980s, but its DNA is alive and well in 2025. Trend following still works. Breakouts still reveal momentum. Stop losses and position sizing still protect traders from ruin. The only difference is that today we have more markets, more volatility, and more powerful tools to apply these timeless rules. In the end, modern turtle trading isn't about reinventing the wheel. It's about applying the same principles with smarter tools, sharper risk management, and the discipline to stick with the plan. Because while markets evolve, the essence of trading success doesn't. And that's what makes the turtle strategy one of the most enduring systems ever created. Now that we've adapted the turtle rules for today's markets, let's put everything together into a step-by-step blueprint. In the next section, I'll give you a 90-day action plan for applying the turtle strategy yourself. From learning the rules to practicing, testing, and scaling up with real step-by-step blueprint. So far, we've covered the history of the turtles, the psychology behind their success, and how their rules can still be applied in today's markets. But here's the thing. Knowing the theory is only half the battle. If you don't have a clear plan to put it into practice, you'll fall back into old habits, chasing trades, getting emotional, and breaking your own rules. That's why in this section, I'm going to give you a 90-day action plan. A step-by-step blueprint to go from complete beginner to confident turtle-style trader. Think of it as a training program. If you commit to this process, you'll build the skills and habits you need to trade with discipline, just like the original turtle traders. Phase 1. Learn the rules. Days 130. The first 30 days are all about education. You're not risking real money yet. You're learning the foundation. Here's what to focus on. Understand trend-following basics. Read about the turtle system. At its core, it's about buying breakouts above recent highs and selling breakdowns below recent lows. Study how stop losses work and why they protect you from catastrophic losses. Learn about position sizing. Why risking 1–2% per trade keeps you in the game, even during losing streaks. Pick your market. Are you more interested in stocks, crypto, or Forex? The rules apply to all of them, but you should start with one so you don't spread yourself too thin. Set up your tools. Open a charting platform like TradingViewer, MetaTrader. Learn how to plot breakout levels, place stop losses, and track volatility. Familiarize yourself with spreadsheets or journaling tools to track trades. The goal for Phase 1 isn't to become an expert. It's to build a working knowledge. By the end of 30 days, you should be able to explain the turtle rules in your own words and set up a chart that shows entry and exit points. If you can do that, you're ready for the next phase. Phase 2. Practice on demo accounts. Days 31 to 60. Now that you know the rules, it's time to practice without risking real money. Every great turtle started by practicing the rules relentlessly, and that's what you'll do here. Here's your roadmap for the next 30 days. Open a demo account. Most brokers offer free demo accounts with simulated money. This is your sandbox. Treat this money as if it were real. Don't take reckless trades just because it's fake. Apply the rules. Exactly. Trade only when the breakout rules are met. Place stop losses at the proper levels. Size your positions based on volatility and your chosen risk percentage. Aim for 20 to 30 trades. The goal is not to make money, it's to build habits. You'll probably have a mix of wins and losses, and that's the point. Losing streaks will happen, and you'll get used to following the rules anyway. Journal every trade. Write down why you entered, where you placed your stop, and what happened. Record your emotions. Were you nervous? Excited? Tempted to break the rules? By the end of Phase 2, you should have real experience applying the turtle system, even if it's with fake money. This is like your flight simulator training. Safe, but realistic. Phase 3. Track trades and mistakes. Days 61-75. This is where most beginners either break through or give up. Why? Because they don't track their mistakes. They blame the market instead of analyzing themselves. For the next 15 days, your mission is to become your own coach. Review your trade journal. Look for patterns. Are you cutting winners too early? Are you moving your stop losses when you shouldn't? Highlight every time you broke the rules. Measure performance beyond profit. Don't just ask, did I win money? Ask, did I follow the system? Even if a trade lost money, if you followed the rules, it was a good trade. Identify emotional triggers. Do you panic after 3 losses in a row? Do you get greedy after a big win? Write these triggers down so you're aware of them. The point of Phase 3 isn't perfection, it's awareness. You're building the discipline muscle by tracking your behavior, not just your results. The original turtles were trained to detach from emotions. You're doing the same. Phase 4. Scale up with discipline. Days 76-90. Finally, the last 15 days. This is where you put everything together and start scaling toward live trading. Go live, but small. Open a real account if you haven't already. Risk the smallest possible amount per trade, microlots in Forex, fractional shares in stocks, or tiny positions in crypto. Keep risk at 1% or less. This is non-negotiable. Your job is not to make millions in your first month. Your job is to survive long enough to let the system work. Stick to the rules at all costs. Remember, the turtles made millions, not because they were smarter, but because they followed the rules when others didn't. Weekly review sessions. Every week, review your trades. What did you do well? Where? Did you break discipline? Adjust your behavior, not the system. Set realistic expectations. You're not trying to double your account in 90 days. You're trying to build the foundation for long-term success. By day 90, you should have a small track record of disciplined trades, a deep understanding of your strengths and weaknesses, and the confidence to keep building. Think of this as your graduation from Turtle Bootcamp. Final thoughts on the blueprint. Let's recap. Phase 1. Learn the rules and set up your tools. Phase 2. Practice relentlessly on demo accounts. Phase 3. Track your trades and identify mistakes. Phase 4. Go live small and scale with discipline. If you commit to this 90-day plan, you'll be miles ahead of the average beginner. Most traders fail because they want shortcuts. They skip the practice. They avoid journaling. They chase big wins instead of small, consistent progress. The turtles proved that anyone can learn this system. The question is, will you have the patience and discipline to stick with it? In the next and final section, we'll talk about the biggest mistakes traders make when trying to follow the turtle system and how you can avoid them. Because sometimes knowing what not to do is just as powerful as knowing what to do. Biggest mistakes to avoid. By now, you understand the turtle system, its history, and how to build your own 90-day action plan. But here's the hard truth. Most traders still fail. And it's not because the system doesn't work, it's because they sabotage themselves. In this section, I want to walk you through the 4 biggest mistakes that wipe out traders. If you recognize these early and avoid them, you'll already be ahead of 90% of people who ever step into the markets. Mistake number 1. Over-leveraging. The first mistake, and probably the deadliest, is over-leveraging. Let's be clear. Leverage is a double-edged sword. It allows you to control a much larger position with a smaller amount of money. For example, in Forex, with 100 to 1 leverage, a trader with just $1,000 can control a position worth $100,000. Sounds amazing, right? But here's the problem. The market only has to move 1% against you to wipe out your account. The turtle traders understood this. They never risked more than 1 to 2% of their capital on a single trade. That's why they survived the losing streaks that crushed other traders. Over-leveraging is like playing Russian roulette with your account. You might win big once or twice, but eventually, one bad move will blow you up. And the worst part? Over-leveraging doesn't just hurt your account, it destroys your psychology. When you know you're overexposed, every tick against you feels like a punch in the gut. You panic, you break rules, and you spiral. So here's the rule. Never risk more than 1–2% per trade. If you think a trade is so good, it deserves more risk. That's usually your emotions talking, not your system. Remember, the market will still be here tomorrow. Your job is to protect your capital so you can be here too. Mistake number 2. Ignoring stop losses. The second mistake is ignoring stop losses. Stop losses are like seatbelts. You don't put them on because you expect to crash. You put them on because eventually, the unexpected will happen. And in trading, it always does. The turtles had strict stop-loss rules. They knew in advance the exact price where they would get out if the trade went against them. No debate. No hesitation. Just execution. But here's what most beginners do. They place a stop, the market comes close, and they say, maybe I'll just move it down a little. The market will turn back in my favor. And sometimes it does. But other times, that small move turns into a massive loss. What happens then? The trader either blows up their account, or they swear they'll never let that happen again. Until the next time. Ignoring stop losses is basically saying, I don't respect risk. And the market punishes that attitude every single time. So here's the mindset shift. A stop loss is not your enemy. It's your insurance policy. It's the thing that keeps you alive for the next trade. Following your stops with discipline is what separates professionals from gamblers. Mistake number 3. Emotional trading. The third mistake is emotional trading. The turtles were trained to follow rules, not feelings. But let's be honest. Most traders are ruled by fear and greed. Fear shows up after a few losses. Suddenly, you hesitate to take the next signal. You second-guess yourself. You close trades too early because you don't want to feel the pain of another loss. Greed shows up after a big win. You feel invincible, so you double your position size, chase trades that don't meet your rules, or skip stop losses because you just know it's going higher. Both fear and greed lead to the same outcome: broken discipline. And once you break discipline, you're no longer following the system. You're gambling. The original turtle traders faced this too. Imagine being down 5 trades in a row. Most people would quit. But the turtles knew that losses were part of the game. They didn't let emotions dictate their decisions. They trusted the system to work over time. So how do you fight emotional trading? With routines. You write down your rules. You journal every trade. You take breaks after losing streaks. You remind yourself that one trade does not define your career. Trading without managing emotions is like sailing without a compass. You might move, but you'll drift aimlessly until you crash. Mistake number 4. Abandoning the system too early. And finally, the 4th mistake. Abandoning the system too early. This one is subtle, but devastating. A trader learns a new strategy, like the turtle system, and they're excited. They try it out, but after a few losses, they start to doubt. They tweak the rules. They skip trades. They jump to another strategy that looks more exciting. This cycle is called system hopping. And it's the fastest way to stay stuck at zero. Here's the truth. No system wins all the time. The turtle strategy, for example, has plenty of losing trades. Sometimes you'll go weeks with nothing but small losses. But then, one big trend comes along. And if you stuck with the rules, that single trade makes up for all the losses and more. If you abandon the system before the big winners arrive, you'll never experience the payoff. It's like planting seeds, but quitting before the harvest. The turtles made fortunes because they trusted the system long enough for it to prove itself. They understood that consistency beats impatience every single time. So my advice? Pick your rules, test them, and commit to them for at least 6 months. If you quit earlier, you'll never know whether the system worked, or whether you just didn't stick with it long enough. Final thoughts on mistakes. Let's recap the 4 big mistakes. Over-leveraging, which destroys both accounts, and confidence. Ignoring stop losses, which turns small problems into disasters. Emotional trading, where fear and greed replace discipline. Abandoning the system too early, which guarantees you'll never see long-term success. If you can, avoid these traps. You're already operating at a professional level. Because the truth is, trading success isn't about predicting the market. It's about managing yourself. The turtles proved that anyone can learn a system, but only the disciplined few can follow it through losses, setbacks, and doubt. Avoid these mistakes, and you'll give yourself the one thing every trader dreams of: longevity. Because in trading, survival is victory, and profits come to those who endure. Now that we've covered the biggest mistakes, let's bring everything together. In the conclusion, I'll recap the key lessons from the turtle traders and show you how you can apply them to your own trading journey in 2025 and beyond. Conclusion. So here's the final takeaway. Trading success is not about predicting the market. It's about following a system and mastering your emotions. The turtle traders proved that with the right rules and the discipline to stick with them, ordinary people can achieve extraordinary results. If you're just starting out, don't risk real money right away. Test the system, practice on a demo account, build your confidence before you go live. And if you found this video helpful, make sure to hit that like button, subscribe, and turn on notifications, because I'll be sharing more strategies and trading psychology breakdowns to help you trade smarter, not harder. Thanks for watching, and I'll see you in the next one.